We were established as part of major clean energy legislation back in July of 2011. I think every state kind of goes through its cycles in terms of when you have really seminal pieces of energy policy. This was Governor Malloy's big piece of public policy that received bipartisan support in the state of Connecticut. As part of this Public Act 1180, it not only consolidated the Public Utility Commission and the Environmental Agency into one, the Connecticut Department of Energy and Environmental Protection, but it also repurposed an existing organization, the Connecticut Clean Energy Fund, into a quasi-public organization called the Connecticut Green Banker. At that time it was called the Clean Energy Finance and Investment Authority. So we are a quasi-public organization. So we are essentially an entity of the corporation of the state of Connecticut. We use private sector disciplines to achieve public sector goals. It's important when you're trying to establish public-private partnerships to be able to operate at the speed of business, and a quasi-public structure allows us to do that. Our governance structure, I think if you were to look at it from a political policy context, 6 of the members are appointed through the governor's purview, and the other 5 are appointed through the legislature. So that's probably a broad way of looking at governance. So we are a new approach. Our predecessor organization, the Connecticut Clean Energy Fund, focused primarily on clean tech, venture capital investing in the early 2000s. Over time, they began to migrate. This is when clean tech was, before clean tech existed. Over time, they began to migrate to providing buy-down incentives for renewable energy, becoming a subsidy grant program. And then in 2011, we were repurposed into the Connecticut Green Bank, so we were really focused on clean energy finance broadly. So our funding sources were supported by a 1 mil surcharge on electric ratepayer bills. It's about $7 to $10 a year per household. It comes to about $27 million of funding a year. That source of funding has been in place since the state deregulated in the late 90s, so it's been around for a while. We also receive RGGI cap and trade allowance proceeds, so 23% of the allowance proceeds come to the Connecticut Green Bank for investing specifically in Class 1 renewable energy resources, and we use those funds to support our PACE program. After building a balance sheet over the course of the last 4 years, we now have a balance sheet of about $110 million. When we started this, our predecessor was very much a zero-based budget. Money comes in, money goes out. In our case, money comes in and it goes out in the form of loans, so it sits as other assets on our balance sheet. We're able to leverage that balance sheet to attract more private investment in our state's economy. And we're looking at, down the road, further capitalization by issuing green bonds. So we're now in a growth market, so we're very interested in now focusing on issuing green bonds. In terms of our products, we have 3 market segments that we look at. The first is statutory and infrastructure. So whatever the legislature says kind of legislatively we have to implement, we have a sector for that. One of our programs is a residential solar investment program. It's an incentive for homeowners to support and buy down residential solar PV installations. We also support co-investments in grid-tied projects. We financed a wind project in Colebrook, the 2nd largest fuel cell park in the world in Bridgeport, so we do those types of activities too. Our commercial and industrial and institutional sector, the really hallmark program there is CPACE, and we'll hear about CPACE over the course of the next couple of days. We were able to not only take a program that was 100% funded by public sources through RGGI, but we moved that to the first securitization of CPACE transactions through a partnership with Clean Fund, turned into a $30 million securitization. And then more recently, at the end of last year, we had a public-private partnership with Hannon Armstrong, which is providing $100 million of investment in the state of Connecticut, giving us a leverage of 9 to 1 on our public dollars. So really a movement from public funds to being a catalyst to attracting more private investment in our economy. And then on the residential sector side, so we learned a lot from Mary in terms of working with local lenders and the structure that they've had with credit enhancing. We've got a product called the Smarty Loan, structured very similarly to what Mary's talked about with Michigan Saves. So that product helps support the implementation of the state's comprehensive energy strategy, which is 40+ measures, and your local community banks and credit unions would provide loan financing through 5 to 12-year terms, anywhere from interest rates not to exceed 4.49% to, I think, 6.99%. We've also got a suite of multifamily products that are really starting to evolve now. We'll be talking about those later on today and tomorrow. Really exciting to see that. We recently closed on a $5 million program-related investment transaction with the MacArthur Foundation. So we think we're going to start to see more foundations wanting to invest in this space to be catalysts in new market development. And then lastly, the product that I'll talk about is Posigen, which is an effort to bring solar PV to the low to moderate income market segment. And as part of that product, we actually have an energy efficiency, energy savings agreement product that's really performing nicely. So we'll talk about that in a second.